Hello, everybody. This is Brad Reed, your real life trader, and I'm here to remind you to be good, and by good, I mean get out of debt and achieve your financial dreams. And one way to do that is to choose a competent financial advisor. Now, some of you are probably saying, hey, Brad, if you're a competent trader, why the heck would you suggest that we choose a financial advisor? And there's two reasons, actually. Number one is while you are learning to trade, you certainly want a competent financial advisor to grow your funds, because learning to trade, as I've said before, is a skill, and this skill can take 2 years to 4 years to 6 years for someone to become competent, and it may take even longer than that to be outperforming a financial advisor. It might be shorter, but for whatever duration, you certainly want to be growing your funds as fast as possible to achieve your goals of retirement, kids' college, personal savings, whatever your goals are. A second reason, and this is one my family uses, is we have a financial advisor to take care of our retirement needs, and then my trading accounts for our retirement wants and dreams. So I'm somewhat diversified across 2 or 3 different advisors. 2 right now. I'm about to add a third. And then, of course, my own trading. And that's the conglomerate of all that is what we are going to use for our goals. So that is why we recommend getting a competent financial advisor at Real Life Trading. And this video is how to choose the best financial advisors from all of the rest that are out there, because there are certainly a lot of financial advisors out there. The lawyers in California want me to remind you that this is a broad base of principles. It is not individualized for any one person. If you do seek individualized or customized advice, please find a competent professional in your area. So again, here's a list of videos. This is the video you're watching is in the bonus video section. You guys can read what's up there. Don't forget, in the stock trading videos, there are videos out there for beginners, for intermediate, and for advanced. There's also videos if you want to become a day trader. And if you have a very small account, look for the proprietary trading videos. There is a ton of education out there for trading stocks and options. Also, don't forget to check out the helpful articles, blog posts. All of this can be found at www.reallifetrading.com. Okay, in this video we're going to talk about what a financial advisor is and why would you possibly want one, as I've already mentioned, what to avoid, what to look for, and then how to take action, how to go about getting it done. So a financial advisor is basically someone that gets paid to invest your money for you. A financial advisor basically does anything that advises you on all things financial, and that includes a lot of stuff such as selling life insurance, retirement planning, like how much to contribute, what rate of return do you need to get during retirement, how much money can you spend, all of that kind of stuff goes into retirement planning. Same type of stuff for kids' college savings, emergency fund planning. There's just a whole bunch of stuff a financial advisor can do for you. The purpose of this video is to help you find one that will do a good job of moving your money into and out of investments based on the changing market conditions and based on the changing conditions of how that money is invested. You definitely want an advisor that will move your money into whatever is going up. There are a few advisors out there, well actually there's many advisors out there that will purposely put you into funds that are going down because they say that helps balance out and diversifies your portfolio, and in that case they're saying diversification is a good thing. To me, if I'm diversified, I want to be diversified across things that are going up, not into some things that are going up, some things that are going down. At any rate, you may want to use a financial advisor to grow your savings faster than you can do it yourself, more reliably than you can do it yourself, and of course with less effort. Most of us want to go to work, go on vacation, play with our families and kids, and have our normal life and not think about how we want our savings invested. And if that is you, then you definitely need a financial advisor. But certainly, as I've said before, while you are learning to trade, you want someone that can grow your money faster, more reliably, and with less effort than you can, because you want to focus your efforts on trading and continue to grow your retirement while you are learning your trading skill. And if you want to diversify, like I have with my family, and we have some financial advisors that are investing part of our retirement, and then I personally am investing part of our retirement. So here are some scary quotes from financial advisors, and I got these I personally am a financial advisor. I don't practice right now, but I have a Series 6, 63, and 65 licenses from a branch of the SEC called FINRA. And while I was going to compliance meetings and other networking events, here are a few quotes I picked up. One is, I want to acquire $50 million of assets or whatever number of assets, and then invest it once and let it ride and play golf every day. This type of advisor does not wish to actively invest their clients' money, although they do wish to get paid for investing their clients' money. It's very unfortunate, but it is very common. This person wants to get paid to do nothing, and they really don't care that their clients are going to lose money. This person says no one knows if the market will go up or down. Now, the scary thing is, to get licensed to become a financial advisor, I had to go through several rigorous tests on what is legal and not legal, but there was nothing about how to be a good financial advisor. So you could become a financial advisor and have absolutely zero knowledge of investing in the market. So these types of advisors are probably going to convince you, hey, not only does the financial advisor not know if the market goes up or down, they're going to say no one's going to know. But heck, why would you be letting someone invest your money if they have no clue on how to invest it? Then this financial advisor says, I invest my clients in equities, bonds, and cash at the same time, because if equities go down, bonds will go up and vice versa. While holding cash just lowers risk. Now, on the surface, this sounds like a pretty good deal. Hey, something's going to be going up at all times. But the problem is, I'm paying this person to grow my funds. Why in the heck would they invest me in something they know is going down? So if the stock market is going up, equities are going up, usually bonds go down. So why would you purposely put me in bonds if you anticipate that they are going to go down? That just sounds ridiculous. If the market takes a turn and goes down, then yes, take me out of equities and put me in something else that will increase in value as the market goes down. But the whole point is to move my money from one investment to another, to always catch or to frequently catch the investment that's going up. But to purposely put me in something that's going down and ask me to pay you for that, to me, is ridiculous. And also to have a percentage of my money in cash and charge me money to put it in cash just sounds ridiculous. Now, I do have a financial advisor that likes cash holdings, but that's because he wants to wait for the next hot investment. So if a percentage of the portfolio is in cash and a new opportunity comes up, he's got some cash right there, we just jump right into the opportunity. So that I'm okay with. But just to lower risk and charge me to do that, I am not a fan of. This type of financial advisor says you should not try to outperform the market. Well, heck, what the heck am I paying you for if it's not to outperform the market? I can go just buy an ETF. It cost me $4.75 from my broker to get into a market ETF. So if you can't outperform that, why the heck am I paying you? Certainly, I should not be paying you to underperform the market. And then, of course, the only exception is if you are close to retirement age and you've already hit or exceeded your goals, you may just want something with a really low beta, and that usually comes with a low percent of return, but it doesn't have to. At any rate, for most people out there, most people watching this video, do not accept a financial advisor that purposely is going to underperform the market and charge you to do that. That's just ridiculous. And then this one is a very recent quote and just drives me nuts. I invest my clients however generates the fewest phone calls. This kind of circles back to some that we've talked before. There are some financial advisors out there that just want to take their fee and never be bothered by you. These folks are more salespeople than they are service members. At any rate, the point of this is to share with you that there are some bad financial advisors out there. I don't think all financial advisors are bad. I don't think many of them are bad, but I think there are certainly a few financial advisors that are much better than others, and I want to help you find who the best ones are. So I kind of took the Jeff Foxworthy approach here. You might have a good financial advisor if you're excited to see your next quarterly statement. If you fear seeing your next quarterly statement or you dread it, then you probably don't have a good financial advisor. If you are excited to see how your money is invested and excited to see how much it's grown, then you probably have a good one. You might have a good financial advisor if you don't care when big market news occurs. I remember my wife and I were by the pool in Puerto Rico, and over in the bar, the TV was playing, and there all of a sudden there was a bunch of clamoring, and she says, "Hey, I think it's something about the stock market." And I was like, "Oh, okay." And she was like, "Aren't you going to go over there?" And I was like, "No, because number one, all of our stock trades had protective stops on them. So if the market did something squirrely, we would automatically exit our stock and option positions. And the financial advisors we have hired have proven that they can handle turns in the market. So if you have a good financial advisor, you don't really care when big market news occurs because you know it's taken care of. You might have a good financial advisor if you don't know or don't care what you're invested in. Recently, I had someone say, "Hey, Brad, what did your financial advisor invest you in?" And I was like, you know what? I don't know, because this person has a 10-plus year track record of success, and I am more concerned with what my trades are in. I'm more concerned with how my kids are doing in school. I'm more concerned with how my wife's training for her mini marathon is going. I care more about life, and I don't care or know what my financial advisor has me invested in because they're good, they're great, they have a long track record of success. So, hey guys, thank you, go for it, do it, and I'm going to live my life. You might have a good financial advisor if you think a bearish market free fall would be good for you. Now, of course, a bearish market free fall is going to be bad for everyone who's just got the let it ride type financial advisors. But if you have a good one, you probably know that the bearish market goes down faster than a bullish market goes up. There's a saying, the bear jumps out the window and the bull creeps up the stairs. And that basically just reinstates that bear markets go fast, bull markets go slow. If you think to the most recent one in 2007, 2008, the market went down 60% in 6 months, but took 4 years to retrace to where it was. So what took 4 years to go up took 6 months to go down. So it goes down faster. So if you have a good financial advisor and the market takes a bearish turn, that good financial advisor is going to put you in things that are increasing in value or certainly not decreasing in value, and you're going to make a lot of money very quickly if you have a good financial advisor. You don't really worry about retirement because you've talked about it with your financial advisor. You're on a plan. You know how much you need to contribute. You know what your financial advisor needs to do, and so you really just don't worry about it. You go about your daily life. You enjoy your kids. You enjoy your family. You enjoy your wife. You enjoy your vacations. And hey, retirement, it's going to be there when I need it because I have a good financial advisor or 3 good financial advisors. So if any of those things resonate with you and you feel like you are a victim to some of those, then keep watching and we'll talk about how to get a good financial advisor. So you want a financial advisor that charges a management fee. This means a small percentage of your assets every quarterly. It's usually reported in a yearly number, and you certainly don't want to pay more than 1.5%, and that's going to be on a fairly small account. If you have $100,000 to $300,000 to $500,000, you're probably going to be paying 1% or less. But the management fee incents the advisor to grow your funds because as your funds increase, their fee increases, and as your funds decrease, their fee will decrease. So your advisor is heavily motivated to make sure that you are successful and that you hit your goals. Now, some advisors charge a sitting fee. Now, if they only charge a sitting fee, basically they're incented for you to have a good time. These guys typically have comfy chairs, and you get water, soda, maybe even alcoholic beverages during your sitting fee, and it's a good time. But it's not what is best for you to be successful with your funds. Avoid the sitting fee type financial advisor. Now, other financial advisors may charge a load. And what that means is once you get into an investment, that advisor is locked in to a certain percentage of your assets. And that could be up to 7 or 8% right up front. So if you think about it, the financial advisor gets you into this. They get their money right up front. They really don't care, or they are not incented to continue to manage your funds because they've already gotten their fee and they're moving on to the next client. So look for a financial advisor that charges a management fee and avoid those that charge a sitting fee or a load. You also want a financial advisor that is independent of the big banks and independent of the investment choices. There are a lot of banks out there, and there's a lot of investment firms that have their own investment funds. And they put a lot of pressure, incentives, and sometimes it's tied to their paycheck to put clients into their own investment choices. And of course, they're going to tell you, oh no, I don't have a quota. I don't have to do that. I do it because we are the only ones that can choose those funds, and those funds are much better than anything out there. Hogwash. You want a financial advisor that is independent of the investment choices. Avoid those that belong to the big banks and the big investment firms. You certainly want a investment advisor, a financial advisor that can react to market conditions. Ask your financial advisor, hey, what happens if the market goes down? What did you do in 2007, 2008 when the market went down? What did you do in 2011 when the market was flat? What have you done in 2014 when we've had some flat times, some up times, and some down time? What did you do? And you want to understand that the financial advisor didn't just say one size fits all, one investment allocation for everything. You want to see that they are actively moving their clients into the funds and the investment choices that are moving up, regardless of which way the market is moving. Some investment advisors say, financial advisors say, you need to be in equities, bonds, and cash at all times. And that's basically one investment style for all markets. They tell you to be patient when it moves down. They tell you that no one can predict what the market's going to do. And then when the market goes up, they pat themselves on the back and talk about how good they are. No. You want a financial advisor that will react to market conditions. And so ask them, what did you do in 2007, 2008 when the market went down? What did you do in 2011? And ask them what they do and what they have done and the various flat market moves and or bearish market moves. And while you're asking them about that, ask them for their rate of return and compare their rate of return to the S&P 500. They should be able to show you that they have a track record of outperforming the market. Now, it may not be every year. It may not be every year, but certainly for many of the years, certainly on the average, they should be outperforming the market. Otherwise, what the heck are you paying them for? Avoid those financial advisors that encourage you to settle for less than market performance, that are telling you you got to be patient while the market is going down. They talk about dollar cost averaging, which isn't always a bad thing, but you want a financial advisor that has a proven track record of getting you into the investment choices that are moving up regardless of what the market is doing. There's always something that's moving up, and you need a financial advisor that has a track record of finding those investments that are going up and also getting their clients into them at the right time. And while you're talking about track records, you need to know what your goals are. I can certainly help you calculate your inflation-adjusted goal, but you want a financial advisor that is aware of what that is, knows how to calculate it, and can help you hit that goal. You want to avoid those that have no concept of inflation, and certainly those that have no interest in your goal. So these are 5 things that you need to look for your financial advisor. Before you go start talking to financial advisors, you first should calculate your inflation-adjusted goal, whether it's for retirement, kids' college, or whatever it is. You need to understand not just what your goal would be if you were to retire today or your kid were going to go to college today, but what does that number need to be based on inflation when the event will actually happen. So for instance, if your goal is to retire on $500,000 today, but you're not going to retire for 30 years, you need to apply inflation between now and 30 years to see what that $500,000 will grow to. And then you also need to consider how long you plan to be retired and what that $500,000 is going to do during your retirement period. Remember, the numbers say that for a 30-year retirement, prices are going to go up about 300%. So you need to be sure that you plan for inflation through the end of your retirement, not just the beginning of your retirement. Same thing if you're planning for your kid's college fund. Now, when you're meeting with your advisor, use 4% for the inflation number. It's the typical number that's been used for the last, 50 years. That differs from the current actual mathematical average. The current mathematical average for inflation is going to be closer to 3 or 3.2%, but that's because we've had very low inflation the last couple of years because our economy has been very slow to grow. In some years, we've actually had deflation, which is negative inflation. So the current number of 3 or 3.2% is not representative of most years, and that is certainly not the number you want to use to plan for. 4% is a much safer number, so please use 4%. Once you have determined your inflation-adjusted goal, you need to then determine your rate of return that you need to hit in order to hit that goal. Now, that rate of return will depend on how much you that rate of return will depend on how much you can contribute each year towards the goal, towards the savings fund. You need to adjust the rate of return and adjust your contribution until you have something reasonable. So if the financial advisor says your rate of return should be 7% and you need to put in $100,000 every single year in order to hit your inflation-adjusted goal, that obviously won't work for most people. Most people cannot put in $100,000 a year just into their retirement fund. Also, most financial advisors should be able to beat 7% because the stock market average is closer to 10%. So work with a rate of return that is reasonable and that also affords you a reasonable annual contribution. Then go talk to your current financial advisor, talk to other financial advisors, and make changes if needed. Some people get really attached to their financial advisor and they're a friend, and I've actually had people say, I know they won't allow me to hit my goals, but they're very nice and I don't want to take business away from them. And I cannot understand why someone would do that. To me, my retirement is much more important than a business relationship with someone. Yeah, even though they're a nice person, a nice guy or a nice lady, if they're not going to help me hit my goals, my retirement goal is much more important. And if they truly are a friend and they realize they can't help me hit my goals, they're going to help me find someone who can help me hit my goals. So please, 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 if your financial advisor is unable to help you be successful, you need to make a change. Your retirement depends on it. Your family depends on it. Your future depends on it. Now, if you want help with any of this stuff, I would be happy to help you calculate your inflation-adjusted goals, to help you determine your required rate of return, and I can even connect you with competent financial advisors that the Real Life Trading team has screened, and I'll do this all for free. Just schedule an appointment with me, email me, brad@reallifetrading.com, or call me, 1-866-535-3446, extension 4. Let's set up an appointment. It'll take about 30 minutes, maybe an hour. We'll go through everything. We'll calculate your numbers for you. You'll have everything that you need to go talk to financial advisors and tell them what you need and get on a track for success. Thank you guys for watching this video. I appreciate the time that you spend with me. This is Brad Reed, and again, I'm reminding you to be good, get out of debt, trade on logic, not on hope.